As an investor, I've lived through two 50% market declines, 2000 to 2002 and 2007 to 2009. Both times I was scared. Some investors made it through those markets and came out ahead. Others panicked, sold everything near the lows, and some of them never recovered. The difference wasn't intelligence or luck. It was something else entirely. And right now, I'm worried. Not about the market. The market cycles through bull and bear phases all the time. I'm worried about the people who have been riding this bull for years who are now completely unprepared for what's coming up, especially people 5 to 15 years from retirement. If the market drops 50% and takes 7 years to recover, something it's done before, that's your retirement window getting whacked if you are caught unprepared. So today, I want to answer what separates investors who survive from those who don't. Well, here's what I've learned. Investors who prepared didn't panic. Unprepared investors made some similar mistakes. I've studied both so I could be better prepared myself. Here's the model that should help. 3 specific preparations that work together. Miss one of them, and the odds of panic selling or making some kind of mistake go way up. Let's walk through what I've seen, starting with something that actually surprised me most. First, let's consider what happens when you get it wrong. Every major decline eventually recovers, but only if you're still in. Many people intend to hold, then panic and sell near the bottom, turning a temporary drawdown into a permanent loss. Then a lot of times they're too scared to re-enter until after a significant recovery has already happened. I saw this in 2009. People bailed after being down 40%. The market recovered, but a lot of their accounts didn't. I didn't see it so much in 2000 because I wasn't near retirement age and didn't know many people retiring at that point. But still, the real question isn't, will the market crash? It's, can you hold on through it? What I'm sharing today answers that. Strategy number 1, written plans. Successful investors had written investment plans. Not in their heads, written down. When the market drops 30% in a few weeks, your brain's going to be flooded with fear. You can't think straight. Having rules you wrote when calm, that's your defense against panic. In 2008, I had some loose plans written down, basic scenarios, rough goals, nothing you would call comprehensive. I didn't anticipate how deep the market would dive. But even those basic plans helped me tremendously. They anchored me. I was scared, but I didn't panic. By mid-2009, I was ready to invest again, while many others stayed paralyzed for far longer. So what goes into a plan? Well, 3 minimums. First, how much will you actually need in retirement? Maybe that's everything you have saved up right now. Maybe it's some smaller portion of that. Work out what you will need versus what you want or would like. Second, when do you need it? 15 years out versus 5 changes everything. Third, what drawdowns can you handle without losing sleep? In both dollar and percentage terms, figure that out. Think about this under calm conditions, not during emotional extremes. Answer these 3 questions and you've got the foundation for a plan. Here's what a portion of a plan might look like for 2 different investors. In the same market situation, you've got 2 completely different rules. Now, we can make the argument about how good or bad these rules are, but they're valid because they fit different people and they've thought about them. The goal is to have rules written down before fear kicks in. Quick note, for people who are willing to adjust, having re-entry rules is also important. Now, some investors did have plans, but still panicked. The magnitude of the drops overwhelmed them in 2007, or maybe they just felt trapped. A plan helps, but having a structure or method that cushions market dives matters also. This is where diversification comes in. Many bear market survivors were diversified, but not Wall Street diversified. If you add small caps to large caps, that's not diversification. That's just adding more stocks. In bear markets, nearly all stocks fall together. Real diversification means owning assets that might gain when stocks fall, or at least they'll hold steady. Things like gold, bonds, commodities, real estate, things that don't move in lockstep with stocks. Investors who stayed calm in 2008, Most of them weren't 100% stocks. When stocks dropped 50%, their portfolios might have been down 10%, maybe 25%. Painful, but at least psychologically manageable. Let's look at a diversification example. What does real diversification look like? Well, here's one approach that's been shown to hold up in past crashes. Only 35% is in stocks. The other 65% spread across bonds, real estate, commodities, and gold. When stocks struggle, some areas hold steady or gain. You're not depending entirely on stock performance. This cushions matters when fear hits. During the past two bear markets, the S&P dropped by half or more. In 2008, that was like watching a $1 million portfolio become worth $430,000. This diversified approach is only down about 10% in both cases. Going from $1 million to $900,000 is far easier to stomach than watching it turn into $430,000. Now, you'll notice that teal line there. That's the permanent portfolio alternative. Building a 10 ETF portfolio works, but there's an easier approach. That's the permanent portfolio, Harry Brown's 4 ETF strategy, split evenly at 25% each. Simple and surprisingly effective. You can find out more about it in many places on the web. Does diversification work long term? Well, it can be held back when the stock market is in strong bull mode. 2006 to 2024 included 2 crashes and a massive bull. Diversified portfolios outpaced stocks in the bear phases, then gave up some upside during the following bulls. Right now, we're likely in the late stages of a current bull market. It's actually a great time to diversify if you're heavily in stocks. The psychology works best when you're already diversified before the bear arrives. Remember, returns are 0 or negative if you panic sell and then wait years to re-enter. Diversification isn't about maximizing returns. It's about guarding what you have. Diversified investors handled bear markets fine following their plans. Down 10%, 20, maybe 25%. A lot less than 50%. But in late 2008, early 2009, when stocks were on sale, 40, 50, 60% off or more, fully invested diversified investors could only watch. They didn't have any cash to deploy. Meanwhile, others who held a significant cash position, they were buying quality companies at bargain prices while everyone else was just getting over being panicked. That's when I realized prepared investors just don't think defense. They're also thinking offense. Kind of like thinking a few moves ahead when you're playing chess. Cash isn't just about surviving the bear, it's also about being ready for what comes after. So the third protection is strategic cash. I know how that sounds. Cash loses to inflation, cash is trash, every advisor stays fully invested. Mathematically, they're partly right. But in 2008, I held a huge cash position. It helped me be calm while the market cratered. In early 2009, folks in cash were ready, psychologically and financially, to buy back in. Cash serves 2 purposes. It manages your psychology during decline, and it gives you an opportunity at the bottom. You're prepared both for the bear and the bull that follows. Warren Buffett has hundreds of billions of dollars in cash right now for exactly these reasons. He's positioned for the full cycle, and he'll be ready to deploy that at the opportune moment. That brings up the question, how much? Well, if you're 15 years or more from retirement, maybe just 10 or 20%. You have plenty of time to recover, plus that gives you a little buffer and some buying power. If you're more like 5 or 10 years out, I'd lean more towards 25 or 30%. You have less recovery time, and that means the psychological anchor of cash means much more. At a minimum, generally keep 1 year of cash available if you are coming up on retirement or already in retirement. That can transform your whole psychology knowing that money's there ready for you. So cash helps you avoid sabotaging yourself and positions you for opportunity. Those are the 3 protections in a bear market: plan, diversification, and cash. For most investors, that's enough. But a few want to do more than just survive bear markets. They want to actively avoid them and thrive. The 4th path is dynamic allocation. Adjusting stock exposure based on market conditions. In strong markets, you're in 100% stocks. When warning signs appear, you start dialing back. In a bear phase, you don't have any stock exposure at all. You're responding to what the market tells you. This isn't passive. This is active. Monthly adjustments, maybe more. What do you need? Well, 3 things. First, the reliable method. Objective rules with technical indicators, valuation metrics, a full systematic approach. Second, discipline to make uncomfortable moves. Third, comfort with active management, with moving in and out of positions on a frequent basis. Now, how to get signals? Well, you can build your own system through studying and backtesting, or you can follow a signal service that handles analysis. Both work. Depends on whether you want to be the expert or to follow one. During the financial crisis, buy and hold investors were down 57% peak to trough. One dynamic approach was actually up for the period, thriving instead of just surviving. If building your own system sounds overwhelming, we offer signal services. Not pitching here, just being complete about options. The link's in the description. So there are 4 paths to protect yourself from panic selling at the worst moment in bear markets. Written rules for when you're scared. True diversification that softens the blow. Strategic cash that lets you sleep and gives you opportunities. And for some, dynamic allocation that moves you out of harm's way. The question is, what level fits you? Your timeline, risk tolerance, personality, willingness to be more active or a more passive investor. The next bear market is coming. When it arrives, prepared investors will survive. The unprepared, well, I'm worried for them. This week, pick one of the strategies mentioned. Take one concrete action. One strategy, one action this week. You don't have to diversify or move a whole lot of money to cash. You can phase those in over the next few weeks or maybe even the next few months. If you aren't the do-it-yourself type and you don't want to tackle this on your own, that's fine. Find a financial advisor to help. These matters are too critical to leave to chance. The important point is that the time to prepare for a storm isn't when the sky has already become dark. It's when the sun is shining and you can think clearly. I was scared during those last 2 bear markets, but I made it through because of some super simple protections I had in place. With the information you have in this video, you are much better prepared than I was. Now, my preparations didn't completely eliminate all of my fear, but they did prevent panic. There's a difference. You're growth guardians. You've built something meaningful through discipline and smart decisions. Now prepare to protect it because you're wise enough to know when storms are brewing and experienced enough to know that the prepared survive. Thank you for watching. You've got this. This material is for educational purposes only. It is not personalized investment advice. Nothing here is a recommendation to buy or sell anything. Here is the full disclaimer statement.